Hello, good afternoon. Welcome to MF Corner on CNBC TV 18. I'm Vinnii Motiwala and thank you so much for tuning in. Today on MF Corner, we're going to be discussing some important changes that have come in and why banks have started slashing their deposit rates. This is coming after the RBI repo rate was cut recently. And what is happening to savers? Now, what are they finding? Their returns are actually shrinking. Whether you look at saving account, fixed deposits, that will start shrinking in. Now, as interest rates on traditional bank deposits head lower, many investors seem to be now looking for better short-term alternatives, more liquid alternatives as well. So what are those alternatives for you all? What is driving this shift mainly coming in towards the liquid funds? What does it mean for your portfolio in the coming quarters? To discuss and help us decode all of that, the outlook for liquid as well as overnight funds, we are joined by Kaustubh Gupta, co-head of fixed income at Aditya Birla Sun Life AMC, to talk to us about all of that. Kaustubh, good afternoon and thank you so much for joining in with us as always, because this is a topic that is piquing the interest of investors right now. Everyone wants to know, what should I be doing? Now, let's just start with the basics. With RBI adopting an accommodative stance and banks lowering deposit rates right now that we've seen coming in, and these are big banks, right, which we've seen in recent times reduce this deposit rate. What is the outlook for liquid funds as well as overnight funds in the coming quarters? What do you see the trajectory of this?
Yeah, as you said, that rightly said, that the RBI has adopted the accommodative stance, and as the name of these funds suggests, that these funds, they broadly track whatever is the RBI operative rate and their stance on the liquidity. So the blend of both do impact these funds as well. If usually these funds, they do track between 50 to 100 basis point over the operating rate, depending on the stance. Given that the stance is liquidity, and the RBI is very aggressive in adding the liquidity to the banking system, we do expect these funds broadly to track the operative rate plus 50 basis points in terms of investor experience incrementally.
You know, Kaustubh, if someone has those savings account, right, HDFC Bank, Axis Bank right now, these are the ones which I'm just naming, have reduced their rates, okay, to as low as much as 2.75% is what one would be getting on that savings account. What are the key reasons, or positives that you should tell an investor to consider shifting maybe that excess fund that they have to something like a liquid or an overnight mutual fund instead of just keeping them in the saving account? What sort of trajectory is there in terms of returns also?
You need to understand that banks are usually driven by their NIMS margin target, and that's the key focus for equity investors in these banking and generally the management of the bank. And as RBI is pushing for rate transmission to be happening faster and more effective, the asset side of the banking book are getting reset or they are being forced to reset much faster. You also need to be noted that for the first time, the external link benchmark loans are highest and are as closer as 40% of their asset book, which means that every time RBI is easing rates, the rate easing trajectory is being passed on faster. To accommodate this reset in asset book, banks need to lower their deposit rate in equal quantum and much faster as the asset book is being pressurized due to cut in interest rates. And which is why all these banks that you spoke about, they are cutting their savings rates and deposit rates in order to save this net interest margin. Now, unlike this, the liquid funds, the operative rate, as I told you, is the RBI operative rate plus 50 to 100 basis point depending on the liquidity instance. And which is why in current backdrop, when the liquidity is accommodative and RBI is aggressive in making sure that this transmission happen faster, the experience most likely of these funds should be much more better compared to the traditional deposits on the ultra short term space, or you can say the CASA savings. And which is why in order to optimize the short term investments, the investor need to look upon beyond these traditional deposits, and which is where these funds, they make a lot more sense.
Absolutely. And what is a typical return, for liquid or overnight funds compared to current savings? How much better could they be making on, these funds?
Look, being the market participant, we can't guarantee the returns. But as a matter of fact, if you look at the historical perspective, over the large banks, the CASA rates, these funds have generally given between 250 to 300 basis points lower compared to the CASA rates. So this moves again in line with the liquidity. In the current accommodative liquidity, one should expect on the lower end of this range.
Kaustubh, just a general question. Where are these investments which are there in liquid funds? Where do they invest the money, liquid funds or overnight funds? It's equity markets only, or is there some other format that they follow for these funds?
So these funds, they don't invest at all in equity. Overnight funds, by mandate, they are supposed to invest only in overnight instruments, which is most of it is in traps, which is guaranteed by RBI. So practically, it's a sovereign exposure. Against that, liquid funds, they run duration anywhere between average 30 to 75 days. And they do invest in money market instruments having maximum maturity of 90 days, which is why at a portfolio level, the average maturity is between 30 to 75 days, depending on the month of the seasonality of the quarter. And because they are investing beyond overnight instruments, the term spreads of 30 to 90 days, which typically move between, I would say, 50 to 100 basis points, that kind of spreads is what we offer to these sets of investors.
Okay. And Kaustubh, for what sort of investors, when should one go for actually a liquid fund, which is more suitable? And what scenario would you say one should go in for an overnight fund instead?
So investors with up to 7-day of horizon, they can look at overnight funds. Anything beyond 7 days to 30 days, what we advise investors to look liquid fund as a substitute to their fixed income investments.
Okay, and is there a difference in terms of maybe some expense that they would be spending on liquid fund and overnight fund?
Usually, most of these funds, they charge between 10 basis point to 20 basis points as a management fees or expense.
Okay, thanks so much for that. But, so what are the factors that one should actually jot down, right? Other than if I know if it's 7 days or above 7 days, then pick and liquid and overnight fund on the basis of that. Are there any other factors that one should be considering while looking at a liquid and an overnight fund? And how important is also emergency compass at such a time that you need to maintain? What should they be doing here?
Well, I think in all these funds, the redemptions, or as far as the liquidity is concerned, that is available to the investor on a T+1 basis, which means that you give a redemption request today, the money will be credited to your bank account by tomorrow, first half. In fact, for the short-term requirement, which is up to 50,000 rupees requirement, the money is available at an instant redemption basis. So from that perspective, this fund is as good as like a bank deposits up to 50,000 rupees each scheme, which is liquid and overnight at a fund house level, and at an industry level also you can have many more such investments. Now, as far as I would say in terms of consideration, clearly beyond liquidity, what one should invest, they should think for is that this clear timeline that up to 7-day money should ideally go to overnight, and beyond 7-day money should go to liquid fund. One should be cognizant of the fact that liquid funds, because they invest between 30 days to 90 days paper, they do carry a little bit of, I would say, duration, or you can say a credit risk. But most of these investments are made in highest rated short-term paper, which is A1 plus. So these rates are negligible, but they do have these kind of risk, and which is why the duration of or average maturity or holding of these funds, they take care of these risks as well.
Okay, surely that is interesting to watch out for there, and how everything is managed for the funds as well. Short term is mainly the bet that comes in for these kinds of funds, and they are quite liquid is what Kaustubh was highlighting. So not much of a worry how you have your normal deposits. That's how you can work around this as well. Not much in terms of a time period that will take to liquidate the funds as well. But on that note, we're going to slip into a very short break, and we'll continue with this discussion on the other side with Kaustubh Gupta on bank saving, interest rates, mutual funds. So don't go anywhere. Stay tuned in. Welcome back to MF Corner on CNBC TV 18. We still have with us Kaustubh Gupta of Aditya Birla Sun Life AMC on bank savings interest account, as well as your liquid and overnight mutual funds. Kaustubh, how safe are liquid and overnight funds versus something when you say a savings account, right? Because what are the factors that they should consider could be risks for this side of the funds that we have?
I told you that any fixed income instruments on the mutual fund platform, they typically carry three kinds of risk. One is liquidity, second is duration, and third is credit. Now, because these funds, they do invest in up to 90 days paper, so there is little bit of mark-to-market risk which is being exposed to in terms of interest rate movements. But by having a duration ability, or you can say clarity in terms of holding period of 7 days or more, most of the scenarios, these MTM risk in terms of interest rate movements is being taken care of. The second bigger risk is on the credit side, but again, because we do invest in A1 plus papers, which are highest in short-term rating, and most of these investments are made in well-known companies by adequate credit research by in-house and being done by most of the, I would say, the capital market entities. The perceived risk or the liquidity risk is again is marginal. The third, in terms of overall liquidity of the portfolio, so because on an average about 15 to 20% of the funds get matured every week, so per se fund doesn't carry any large liquidity risk. On top of it, these investments are liquid, so there are banks and other corporates which are always available to buy these up to 1 to 2 months papers in order to maintain their LCR ratios. So that liquidity risk is also taken care of. So in a sense, I would say that yes, there is little bit of mark-to-market risk on account of interest rate movement or on account of the credit move, but all mutual funds, they do take care that enough guardrails are in place so as to make sure that these risks are adequately taken care of.
Now, Kaustubh, when I'm looking at just March 2025, you saw a significant outflow from liquid funds. Largely, what it was attributed to was seasonal corporate withdrawals. Should retail investors be concerned about such a volatility in terms of the fund flows, or is it normal market phenomena? How should one be reading that as well?
So these are seasonal factors. Every year in run up to March, the demand for money goes up on account of the accounting closures, and that's when large amount of redemption happens. And we have been meeting these redemptions adequately within the regulatory framework since ages. So it's a normal phenomenon. Investors should not be worried for it. If you look within a week of March crossing, again these funds they do come back to these category of funds as a part of their normal investments.
Okay, and what is the best way in terms of an investor combining saving accounts, mutual fund categories to balance and get better returns? Any tips and suggestions that you have how they could maximize the returns from liquid and overnight funds?
Again, it's a little bit unfortunate, but irrespective of monetary policy bias, funds like liquid and overnight, they have generally deliver good returns compared to the traditional very short-term or ultra-short-term deposits. Just because of the lack of awareness, or you can say the ease, and to some extent the laziness attitude, some portion of your money, or I will say significant portion of your money, do end up parking in bank deposits. So it is especially in the current scenario when the RBI is in rate easing cycle and the accommodation stance is in place, which means that enough liquidity is being assured by central bankers. These funds, from a return expectation or experience perspective, they make even more sense. So from taking these into account, my takeaway is that investor, at least some portion of their deposit, they should look to diversify away from keeping in CASA or in a very ultra short-term deposits to these category of funds. And as their experience matures, I think they will be knowing themselves by running on the treadmill that it makes sense that they become part of their investment allocation.
Okay, Kaustubh, what role do these funds actually play in terms of your overall portfolio? Not specific time, but overall my portfolio. How important are liquid as well as overnight funds for an investor And especially if you have a low risk appetite, how much should your investment actually come in here, even though it's short term?
So all your emergency funds, the funds that you think that you need for maybe meeting your expenses for next 1 month, they should find the way to this category of funds.
Okay. And in terms of someone who's just starting out, right, what are the options that are there in this liquid fund or overnight funds? Like normal funds, you do have SIPs, lump sum, systematic transfer plan. Is that something that we have here as well?
Again, these funds, because as I told you that they run very negligible risk, my advice to investors is that you start incremental investments, whatever you are doing as part of your fixed income allocation to these funds. And as your experience turns out to be, you can increase allocation over a period of time.
Are there any sort of tax advantages that one could have because of liquid funds as well?
No, they are treated at par or parity with the traditional deposits.
So there is no sort of tax benefit that one can watch out for here as well. Okay, and just in terms of overall, what is it that one should watch out for in terms of what is the right time for me to start a liquid fund? Is it always whenever I have any cash in my saving accounts makes sense to move it here, or is there a particular time when you could do better by investing in a liquid fund for a short period of time?
So it's like, because it's a temporary surplus that we advise investors to come into these funds. Anytime when you are having a surplus, you can come and invest in these funds. In terms of experience, of course, once you are crossing your quarter or your particular month end, because at that time the money market rates in the ultra short term, they do tend to go up, and then again they tend to go down. So those kind of small capital gains, they do accrue to this category of funds. But those are more tactical calls. From a all-season perspective, my advice is that, especially in a rate easing scenario, and especially in a scenario when central bankers are pushing for a rate transmission faster to the banking system, these funds, they do make a lot more sense for your very short-term deposits in order to optimize return on them.
Kaustubh, have you already started seeing a sentiment shift or an investor shift coming towards liquid flows and liquid inflows, liquidity as well as overnight funds?
Yes, so there has been some traction from the retail investors over the course of last, I would say, 2 to 3 months, where we have seen there is a clear shift on the short-term investments to these category of funds.
Okay, and are there any scenarios that an investor may actually face in terms of delays or restrictions from withdrawing funds? Are there any such cases or scenarios in these funds where we could face some problem?
By regulation, we are supposed to give liquidity on a T+1 basis, except for, as I told you, 50,000 rupees, which is available on the Insta redemption request. So whatever the redemption request, we get it. We need to honor that payment. And as I told you, that the portfolio is adequately liquid at all point of time because of variety of regulatory needs, and because of the construct of the portfolios are fairly liquid. So we don't envisage that kind of scenario playing out in these category of funds.
Kaustubh, if you could just help us understand that, is there a specific, because now the RBI is also focusing a lot more in terms of liquidity so that the transmission happens quicker, right? That's how we started the conversation. So if there are more cuts that come in, then does that indicate that, these funds would do much better in the near term as of now, or historically, how have they moved when we are seeing changes in rates?
So these funds, as I told you a while back, that these funds, they very closely track what is the headline repo rate or the operative rate in the country by the central banker, and second is what is the liquidity stance. Historically, the spreads or the YTM of these funds, they have tended to move between 50 to 100 basis point, depending on the liquidity stance. Given that the stance is positive or accommodative and the liquidity is abundant, we do expect that the YTM of these funds, they will be tracking closely about 50 basis above repo. The point is, compared to the traditional deposits, where most of these deposits, they are tracking sub-repo, so compared to them, it become a compelling case, especially in current macro backdrop.
And what is your advice to an investor who sometimes still feels hesitant to actually look at liquidity funds and overnight funds versus bank deposit, because they sometimes just think like, okay, if I've put it in an FD or if I've just put in my savings bank account, it's okay. They don't want to take the risk, or they find this risky. Could you just advise our viewers?
So the point one, as far as overnight fund is concerned, there is no risk at all whatsoever, because in that category of funds, the underlying investment is mostly the TREPS, which has been guaranteed, or the settlement of that is being guaranteed by one of the RBI entity, which is CCIL. So it is practically the sovereign risk. Even one can argue that even better than banks. So those category of funds is clearly, from a risk perspective, are clearly out, and most likely better than the very short-term deposits. As far as liquid fund is concerned, my advice to the investor is that the history has suggested that as an industry, we have been able to manage across cycles, irrespective of whether it is 2008, 2012, 2018, or 2020. But more important is that if you are still reluctant to it, I would advise that some portion of your these short-term deposits, you start parking with these category of funds, experience yourself, and then make the I would say more rational judgment.
Okay, and while picking out a fund, maybe if I have to pick out in terms of different options that you have for liquidity and overnight fund, what are the best points that one should look at, or a checklist that one should have while picking the funds?
So first of all is your average maturity. That is how long is your money available. If it is less than 7 days, go to the overnight funds. If it is more than 7 days, come to liquid fund. That's the first checklist, which is what is the expected duration of your investment is likely to be. The second thing is that within the liquid fund category, you can look for average maturity. If rates are easing or liquidity is abundant, probably the longer maturity, average maturity fund is likely to give you better experience. Then there are portfolio cuts that you can look through in terms of credit profile, in terms of the maturity profile, week wise, month wise, and then you can take a more informed call for the investors who understand these capital market nuances.
Okay, Kaustubh, thank you so much for joining in with us, reassuring our viewers what liquid funds mean, overnight funds mean, and why are they so risk-free. There is no risk coming in there, so you should not worry while investing in these funds as well. They are a short-term bet for your savings which are lying idle, and a better way to park your money which is just there in your savings account. So thank you so much, Kaustubh, for joining in with us. And with that, we'll wind down this edition of MF Corner on CNBC TV 18. Thank you so much for tuning in. Up next, we're closing well.